please.
Well, hello everyone. Very nice to be in Dubai. I come from Denmark. I represent Saxo Bank. It's a global online trading bank which was started something like 20 years ago. We have offices 24 countries around the world. We have offices in Dubai. We have in Abu Dhabi. We basically provide access to global markets through our online solution, which obviously covers, well, 30,000+ products, including commodities. So I'm covering the commodity part of that. From a strategy point of view, we look at what are moving the market at the moment, especially primarily from the investment side. I don't come from the physical side, so this presentation will more be looking at some of the macro and the financial aspects of gold. The question is gold shining? It definitely is shining. Is it going to go up? I think it will, but there are some hurdles along the way. If you look at the outlook at the moment for the global economy, we obviously see that the U.S. economy has been growing now for the past few years, only around 2%. Nothing great, but at least it's better than what we have in Europe, where I come from, where we're almost fighting a recession. The emerging markets are also slowing at the moment, especially led by China. That is a natural process that they have to go through. And that obviously will be something that will be continuing for the next few years to come. There are obviously many different key drivers for gold these days, apart from obviously the supply from the mining industry and the profitabilities of mines. The dollar is really one of the keys, and we're just going to look at that because most of the move we've seen just recently has been very much driven by the dollar. What happens to bond yields around the world? Because again, if you are an investor and you're looking for gold, you're also looking obviously the other asset classes, equities and bonds. If interest rates are going up, then the opportunity cost of gold is going up as well. So the level of global bond yields, especially in the US, is playing a role here. Physical demand, as has been talked about. Speculative positioning, I'm going to talk about that a little bit as well, because obviously there is obviously a lot of investment demand going in and out of gold, so from hedge funds and investment managers, and how they're thinking and how they're positioned is obviously a key driver, at least in the near term, for gold. And then obviously we have also some of the unexpected. The Swiss gold referendum was mentioned earlier. I'll just touch base on that. It could become a Scottish moment, and that's worth keeping an eye on. The global slowdown could accelerate more than we expect at the moment. And what would then happen to the Fed's, the U.S. Federal Reserve's intentions in its interest rates policy? So just looking at U.S., as I mentioned, growth has been steady, nothing dramatic, but at least it is growing. A bit of a slowdown at the moment, but probably expecting that to stay around these 2 to 2.5% going forward. And it's driven by as you can see, the GDP has been fairly stable. It's been driven by the labor market, which is looking a lot healthier. Housing prices has been going up, and that's obviously helping over there. China is a little bit of a different story. They are obviously currently in the process of weaning themselves off being the factory of the world. That moves demand towards potentially other metals, or the mix of the demand is changing, and that's also having an impact on the economy. Just this morning, 7.4% is the growth for the last quarter, annualized, the lowest since 2008. So that's obviously a development worth keeping an eye on. I'm just going to move on because we really want to get to the core. Just looking at euro as well, because the euro is important because it does have an impact on the level of the dollar. And in Europe, we're really struggling at the moment with growth. We're not seeing much of a pickup quite far out into the future. The worries in Europe is obviously that we could become a new Japan, where we've seen where they've been fighting to get growth back now for past two decades. As a result of this, interest rates has been falling, inflation is falling. That is a worry, and high unemployment is obviously putting extra pressure on governments and on the central bank to act. And at the moment, the expectation is that we're going to see some kind of quantitative easing from the European Central Bank. That will obviously change some of the dynamics between Europe and the US in terms of the level of the dollar. But before we see that, this is just looking at the Fed funds. After the recession in 2008, we've obviously been almost flat, close to zero for the past 6 years. there are expectations now that interest rates is going to rise next year, but just over the last month, you can see there's been quite a sharp slowdown in the expectations, and that's actually coming down still. So, from having looking at an interest rate rise next year around April, it's now looking at more towards October, November, and it's obviously starting to raise the question: are they going to raise interest rates? Because just recently we saw from the U.S. government or the U.S. Federal Reserve that they are worried that the dollar has risen very fast. They're also worried about the slowdown around them. And obviously U.S. is not isolated, as they're not living in an isolated world, so they are dependent as well on the world outside them. And that is kind of doing the tightening for them at the moment. So the question is, how much will they tighten? I'm just going to jump this. But overall, now we start to get to the core. This dollar rally that we've seen over the past quarter has obviously had a very profound impact as well on the gold. We've had a very, very high correlation between the two. That has been the main reason for the headwind that we've seen in gold since the summer. We had a bit of a bounce early in the year, Ukraine, and then we had the IS militants in Iraq back in June. But since then, the dollar has started to rally, and gold has been struggling as a consequence. We're seeing a bit of a pickup at the moment. The dollar rally has halted, at least for now, but we can see this very, very strong relationship between the two. And now we come to the investment outlook because at the moment where the risk of further dollar appreciation still exists, there is quite a lot of momentum in the markets at the moment towards buying dollars and seeing the dollar go higher. That leaves gold obviously still at risk. And if you look at these two graphs, the blue one is gold in euros, priced in euros. It's up around 10% this year, while gold in dollars is close to unchanged. And if we see this is a chart of the gold against the euro, and we actually been in an uptrend since beginning of the year. And at the moment, if we can break, I think it's 982, 983, we're kind of getting above this downward slope we had for a while. So there is potentially some further upside in gold near term against the euro. So from a trading perspective, what we're telling our clients at the moment, if you want to buy gold at this stage, potentially just have a look at euros initially, because if the dollar is going to go higher, you may have a better opportunity to go into gold against dollar at a slightly later stage. So 985, yeah, that's a level. That's what we keep an eye on at the moment there. But at the same time, what are the speculators doing? This is data that is released every week by the US authorities, which basically where hedge funds and large money managers, they have to tell the authorities what kind of positions they hold. And we can see during the sell-off, during the sell-off is here, the price is down here, we've seen the net long has been falling quite sharply. Not really because the long has been reduced, but because we've seen quite a big increase in short positions. So basically there's a lot of increase in speculators looking for a further fall in the value of gold. That has stabilized and we actually reached the record. And when we see these big movements in the market, it starts to increase the risk of an adverse move against them, because when things get this elevated, you know if there's a slight change in fundamentals, then there's a big short position that needs to be covered. Vice versa, obviously, when the market is very bullish and going up. So at the moment, this is actually adding some support to the gold. So you don't even need new buyers to come in to drive the market higher. You just need short position to be squared in order to kickstart a movement in the price of gold. Hedge funds are notoriously for a lot of what the kind of investors we see is quite often retail, but it's also medium-sized to also all the way up to large wealth, large family office. But hedge funds, they do tend to react a lot faster than most of us. They look months ahead and see changes coming. And this also happened back in October 12th, where we can see the hedge funds positioning. By the time we reached the big sell-off in April last year, hedge funds were almost out of their positions. They started to sell already back in October. If you look at investors in exchange-traded products, that reduction didn't really only start until the price actually started to move. Sorry about this. As it started to move, so they were quite a bit later in reacting to the market. And that's been mentioned as one of the risks right now, that the market feel that yes, we've been very steady in terms of holdings in exchange traded products or exchange traded funds for the past year, but the price of gold has been coming down, and there's a little bit of worry that, well, could we see another cascade to the downside? I don't think so, because the reason why all the negative drivers for gold we've known for quite a while now. We know the inflation is low. We know that the U.S. Federal Reserve eventually is going to raise interest rates, and these are from an investment point of view, they are all known. We've seen stock markets start to be a little bit of a wobble recently. That's adding some support. We saw that last week. So I think this is just those who are holding gold today through exchange traded products. I don't think they're basically there for the long haul. They are not looking to reduce much further. So I think we are creating a bit of a base there in terms of holdings. Silver is a complete different world. While silver's price has collapsed over the past few years, holdings just continue to rise. And so silver investors, they really have either deep pockets or they have a very long time horizon. They're content with their position. And again, there's a worry that silver, if it falls further, some of these will have to start selling out. But again, why wouldn't that have happened a long time ago when we've seen this continued weakness? And just recently, we actually reached a record high in terms of holdings. Hedge funds, on the other hand, they're all over the place. The big reason why we saw silver sell off so heavily the past few months was due to this big spike in speculative position that we had in silver back in April, May. We broke a technical level to the upside. A lot of speculative money went into silver. It didn't happen because suddenly the dollar started to rally, and that broke off the move. And since then, we just saw weeks and weeks and weeks of selling by funds, bringing their position back down, and now they're actually net short for the first time in quite a while. If you look at commodities in general, I cover the whole spectrum, obviously here in Dubai, and these past couple of days there's been a lot of talk of oil prices, so that's another thing that's obviously a hot topic at the moment. But if you look at the performances, it's not that bad actually. Palladium is still up, well up on the year. Silver is down an equal amount. Gold is kind of hovering around unchanged. And with all the bad news or all the potential talk about gold not being a good investment and investment banks coming up with their $900, $1,000 projections, well, again, I'm just arguing we would have seen that already if that really was the case. Sector, again, one of the best of the major sectors this year, only down 1%. Obviously, all the action has been in softs and livestock this year. But if we look at the current market, I think we are very close to finding some support in the market, if we haven't found it already. If we look at this big move from 2001 up to 2012 when we peaked, 1,090, that's half or 50% correction of that whole move. That in itself is a significant move or significant support. But I think actually already here around the 1160 to 1180 could potentially provide enough support for gold to flourish again. At the moment, it's with around 1250 today, so we're continuing to see some support from reduced expectation to interest rates in the US, but also stock markets, which are a bit worried at the moment, and that's adding a little bit of safe haven support. But still, the option markets, they still believe it's the near-term risk is to the downside. This is showing something about the volatility that traders are paying for options, and you can see over the past month there's been quite a big spike. So people are paying a much higher percentage to protect the downside. That is obviously now slowly changing because we have seen gold started to bounce, but this just gives an indication about some of the extremeness that we had in the market. This is a couple of weeks old, so before we saw before the market bounced, but just to see how the market was positioning themselves towards lower gold prices. But again, now that is being corrected. Another thing that was mentioned as well is obviously the geopolitical risks. These are never far away, and oil markets tends to react the most because quite a few of these have been related to oil-producing countries in the past few years. But so I just put in an oil chart, just give you some idea about some of the spikes we had, and now obviously we're seeing quite a big collapse in oil price. That's due to other reasons, but that's another forum. But just to be aware that obviously geopolitical risk can obviously always add support to the market, and as the gentleman mentioned before, we still have several unresolved items across the world. These are just a few, but there's quite a few at the moment which could suddenly change things around as well. Let me just turn to the U.S. Again in terms of why I think the outlook is changing for gold at the moment. We've had expectations, obviously, for higher interest rates in the U.S. So bond market yields were starting. Last year we saw the bond market in the U.S. from long bonds down to 5-year bonds interest rates started to go up in anticipation of interest rates going to rise. Since then, obviously, the economy has not grown as fast. We are seeing a slowdown around the world. We're seeing near recession in Europe. And look what happened just over the past this past month. We've seen a collapse almost in interest rates. Our chief economist in Copenhagen, he actually wouldn't be surprised if we see a new low in 10-year government yields over the next 6 months. That's quite a statement. But if that's the case, then gold obviously will be finding some significant support. But bond yields are not going up; they're going down at the moment. And how does that impact gold? Well, here I just put in the talk about the opportunity cost of holding gold compared to interest rates. Just over the past month here, we've seen real yields, 5-year real yields in the U.S. starting to fall. This is inverse. So at the moment, if you bought a 5-year government bond, your interest after inflation was minus 0.2%. So that's not much, and just a month ago it was actually positive. So this change is also starting to have a positive impact on gold. Inflation as well. This is a little bit technical, but we're actually seeing that the outlook for QE in Europe has meant that the inflation forecast for the future in Europe is falling slower. It's not falling as fast as it has been doing in the US. And that potentially over time was also could help create a bit of a floor in for this dollar rise that we've seen now for the past 3 months. So at the moment there are calls for the dollar to move down to parity against the euro. I think if we get down to around 120, I think that's probably about it. So that would be the level I will be keeping an eye on from a gold dollar perspective. Just touching base on the Swiss gold referendum, hasn't really been talked about that much. We will start to talk more about it over the coming weeks. On November 30th, the Swiss people has to vote for this referendum. Referendums happen in Switzerland on a regular basis. We've had quite a few since 2000. Only 15% of these have passed. So this is one of the reasons why at the moment the market is not really paying that much attention. But if it does become a bit of a protest vote from the Swiss people towards the government, because many Swiss people feel disillusioned about the Swiss banks losing their anonymity, and the secrecy laws has been reduced quite a bit in recent years. So we don't know basically, and I think, as I heard from a Wall Street Journal guy in Switzerland yesterday, that they expect the first poll towards the end of the week. So basically within the next week we should either pay a lot of attention or just bury this referendum, because if it's 1090 against, then obviously it's not going to happen. But any higher percentage, then suddenly this could become a big issue. And if the Swiss Central Bank over the next 5 years has to increase their reserves up to 20% of gold, that equates to almost half an annual production they have to buy over 5 years. That will create quite a decent flow in the market. So just to sum up, I have more upsides than downsides, so kind of give an indication of where I think it's going. The slowdown in the global growth is obviously hurting the U.S. recovery as well, and that could potentially change the outlook for how rates are going there. Physical buying from Asia, as we heard, will continue to rise. Speculative positions are currently quite extended to on falling prices. Geopolitics are never far away. Stock markets have shown signs of instability over the past week. Again, stock market weakness is playing into the hands of gold investors. Swiss gold referendum, as I mentioned. The downside risk near term, I think the biggest downside is just near term still the dollar. If it rises, then obviously gold will be struggling as well. So just on that basis, from an investment point of view, we look at gold against the euro, not against the dollar at this moment, but we're looking to get back into gold against dollar if we see euro down towards the 120 area. And then obviously if rising interest rates if the outlook we're seeing now start to change back towards rising, but not the way the world is looking right now. So in conclusion, dollar is really vulnerable to further dollar appreciation near term. We're looking at gold against the euro. We think the U.S. Slowing growth will alter the way the U.S. is looking at their own interest rates, and speculative short positions are at a record, and that in itself could change the direction of the market. So near term, 1150 to 1400 is our preferred range. It's where we've been for a while now, but I think we are near the lower end of that range. So we are not advising investors to get out of the gold at the moment. And that's basically it. Thank you very much.
Thank you. Thank you very much, Ole. Are there any questions from the floor about this? Ole's had the challenge of being the last speaker, but I think...
There's a question here.
Yes.
Hi. The US Fed have just gone through a period of printing a lot of money. Typically, we would associate that with an inflation. How come we haven't seen this, and would we expect to see it as growth returns to the US economy?
As long as the economic growth globally has been so weak as it has been, it has not created inflation just purely from the fact that unemployment has been rising. So price pressures there's not been any price pressure in the system anywhere. We came out of a credit boom back in 2008, 2009. Many people are still more in a phase of reducing their own debt than actually thinking about putting on extra debt. So I think that really is yes, there's been a lot of money pumped into the system, but we have not seen the impact down on the you and me level. Basically, it's not filtered through strong enough to the man in the street, basically. So unemployment is rising. So there's still countries where people are more worried about keeping their job, and so they're keeping their spending back, and that's obviously helping to keep inflation down.
Is it a time bomb waiting to happen?
Sorry, come again?
Is it a time bomb waiting to happen?
I think we have a mountain of debt, and as long as the governments, especially in Europe and to a certain extent US as well, continue to have an investor who's confident enough that the money will be repaid, then it obviously can carry on for a long time. I'm worried about Europe especially because debt levels are astronomical. Governments' willingness to give up on decades, on centuries of how to do things is very difficult to change. So in Europe we are pushing a mountain in front of us, and we've been saved by the central bank, the European Central Bank, on a couple of occasions. The question is obviously, and that's increasingly being raised: are they running out of ammunition? How much extra can they do? And how much will the Germans allow them to do? So we are not out of the woods yet in terms of. We just saw last week a dramatic spike in government bond yields in Greece, Portugal, and Spain. Not as anywhere near to where we were, but it just indicates that this kind of worry is coming back, and this despite the expectations in the market that the ECB will step in and buy bonds on a massive scale. The question is, how much does it help when interest rates are already at 0%?
Any other questions from the floor? No more. Well, I think we'll just finish here. Thank you very much for the interesting presentation.
Thank you very much.
Let's go on for some.
Thank you.
Thank you.